Okay, so Debo, you have the floor now.
Okay, I've got the screen share. So let me know from time to time if I need to let someone in or something like that.
Okay, I think you're going to have to nominate someone else because I will need to leave the meeting very soon. You need to nominate someone else to do that.
I guess it will have to be Kunle now.
Okay.
Oh, sorry, my network was switching to another network. So
all right,
I went off briefly. I'm back. So I think, I don't know if you guys heard all what I was saying. I was just talking to myself.
We started hearing you then.
But whatever it is, I'm pleased to welcome everybody to our session for tonight. Oh, okay. So
I think we may have lost him again.
Let's just jump right into it. Debo is a bit versed in law of startups, and he has to read. Yeah, so Debo also has a venture capital. Capital firm that is retailing that opportunity. So yes.
Yeah, Kunle, you were going in and out.
Yeah, you have the floor.
All right, but thanks very much, Kunle. Good evening, everyone, and maybe afternoon for some people, maybe morning for others. So today, I'm just going to be sharing information on investing in startups. But I need to say that this is not financial advice. And some of the companies that you will see in my presentation, I have holdings in them. But generally, it's just an information share. If you need to make investment, you need to talk to qualified persons to guide and give you professional advice. But I'm always happy to have a chat to share my knowledge based on my experience. All right, thank you. I thought it would be good to start by showing my face, what I look like before, the one you have below, and what I look like now. I think there's a bit of poshness there, but that's what I used to look like close to the time we were in school. In terms of my affiliations, so like Kule mentioned, Phronesis Capital is something that was founded not too long ago with Taiwa Denusi, and we're bringing other partners on board. Kunle is one of them. Paid-in is a fintech company, UK-based, but we have operations in Nigeria. I'm a co-founder and CEO of that company. We recently launched in Nigeria a couple of months ago. Jenny Solution is my consulting outfit. We also do Internet of Things. That's been going on for since 2013. We have operations in the UK and in Nigeria as well. In terms of school, of course, we all went to OAU. Prior to that, after that, I've done an MSc at the University of Reading and recently completed an MBA from Cambridge. I just thought it's good to share that so that you can see where I'm coming from. I'm an engineer. I'm chartered in the UK. I'm a fellow of British Computer Society, and I'm also a fellow of the Chartered Institution of Highways and Transportation. In terms of today's topic, so we're looking at investing in startups. I thought it's good to show what I've done in that space before we go deeper into some specifics. And what this slide is also showing is what is possible and what can happen when you do invest in a startup. So for me, I've had some great investments that has given 10x or more return on investment. One of them is Bolt. It's an international payment company. Placer is a company that uses footfall to generate market intelligence at shopping malls. All these companies are now unicorns. And then Now RX, it's an online pharmacy in the US, and they're doing very well. I think that one is about 28x return right now, and they're still going strong. So these are all paper results for now. I also have some what I class as good investments. Donzo is a company that Google has also invested in. Glovo was recently acquired by Deliveroo for 2.6 billion. Chip is a UK company that in the fintech space are doing well. And Booksy, it's a company that does reservations for practitioners in the beauty space. So some other good investments, or maybe I'll say wants to watch, TechMate, Go Henry. TechMate, what they do is, with the advent of working from home becoming more mainstream, what they do, they set up a network of tech support people. So you register like people will register on Uber, and then they'll call you for jobs. So you go to people's homes and sort their IT problems. I thought that was a good one. I jumped on when I saw the pitch right away. Go Henry is teaching young children and early teenagers on how to manage money. So you can give them a card, whether it's Visa or MasterCard, but their parents monitor their spending habits, which is quite a good one. Launched in the UK, but now going global. Some other good investment, these ones are like Nigeria and also wants to watch, Tap, Trove, and Blackbird.ng. I also have dead investments. So these are investments that have failed, where I lost completely all my money. One is MIM, NanoSense. This is still operating, but they're never able to meet any objective, just raising and raising. Pretty much my investment there is dead. PowerVault is also a very good company. They have great ideas, but Tesla created a rival product that completely killed their business. And I cannot even find their logo anymore on the internet. This is my first startup investment. And what they wanted to do search on mobile very, very early on. But of course, Google is big in search on mobile, and they're dead, really, really dead. I lost all my money in all the bottom ones. Because this is just to show a flavor of what is possible and what can happen. So there is risk, and investors should beware. All right, but with the risk, with the high risk, there's also high reward. So, but before we get into that, let's look at some other general things that people do invest in today. So I don't know how many people can guess what each of these are. I specifically make it like picture to see if you're awake. So if you guessed right, this is real estate investing. This is obviously stock market, of course, commodities, precious metal, gold. Mutual funds is very common, especially for pensions and things like that. And many people probably hold crypto investments here. Again, it's another asset class. And for some more sophisticated people, they invest in arts. I don't understand it. I don't go near it. And of course, we have startup investment, which is what we're going to be focusing on in this session. Okay, so why is startup investment important? What I've done here is I've gone to Forbes list to look at the top 10 richest people in the world. And as we are all aware, most of these guys have made their money in tech. That is what people say. they said, oh, they made their money in tech. But actually, what is actually quite interesting is that it's not just tech, it's actually, they made their money as a tech startup. So if you look at Bezos, most of his wealth is inside Amazon, and he is the founder of Amazon. So he did not really make money in tech, as most people will say, but he's made money by starting a tech startup. And then many of his shareholders have made money alongside him. Same for Tesla. So you can see here, 7 out of the top 10 richest people have all founded a startup, a tech startup, which means that this asset class is probably the most lucrative of all asset classes, because, you know, it's not just about the founders of this company. There are many people that have become billionaires by investing early in Amazon, in Tesla, in Google, in Facebook, Microsoft, and the likes. Even the great investor Warren Buffett holds significant stake in companies like Apple and some other tech companies. So tech is very important. Also, Mukesh Ambani, who is the richest man in India, also holds a very heavy tech portfolio. So if we have not been looking at tech startup as a way of creating tremendous wealth, I think this slide just captures that. Again, with opportunities, that are always risk. I thought I'll show this slide, you know, showing the risk and the impact analysis. And some of the risk relates to whether the startup can deliver a successful product to market, whether they can scale effectively, whether competition can kill them, whether the timing is right. So I'll talk a bit about timing. Sometimes you have a great, you know, startup idea, but it comes too early in time. And because of that, it doesn't achieve mass adoption. So, you know, you can have everything going right, the market is there, everything is good, but the timing is wrong, the business can still fail. You also have legal issues that can kill a business, like Uber famously had a lot of regulatory issues in different countries because of the taxi services are regulated services, and coming into that space with innovation created a lot of legal and regulatory risk, which eventually they were able to execute. They were able to execute around that. In terms of execution, again, you may have a great idea, the environment is right, you have the funding, but you just don't have the team to do that. Again, I'll use the Uber example. Travis Kalanick is actually one that is credited as having the right sort of personality to change the taxi business. That is not everybody that can do that. So you need to have certain type of personality depending on the nature of the market that you're pursuing. Again, you have to have a good product. You have to be able to deliver on the product that would delight customers. Fundraising is always a risk. If you cannot raise enough funds for your startup idea, then it is almost not going to happen. So again, still talking about the risk, and then I'll talk a bit about, you know, different stages and funding has happened. This is the famous J curve, which is like your startup life. So you start life with maybe some founders fund, and from then on, you go negative, down the valley of debt. And all this time that you're going negative, you're getting funding, right? First you start with your money or maybe your sweat equity, then you try and get some government grants. Maybe you do some crowdfunding, maybe you do some angel syndicate, and eventually maybe get some feeding for some VC funding. But the goal is to achieve the promised land. And this curve actually explains why most startups fail, because you just have to keep digging and digging and digging and digging, and we hope that at some point you're able to achieve product market fit and then start to raise to the promised land. So in this period, a lot of funding is coming in, but the startup keeps making a loss until they are able to survive. So it's really funding to survive for startups. And if you're investing in startup, it's quite important that you understand this. So one thing that comes up quite often in startup is, okay, how do we value the startup? How do we know what the startup is worth? And funding, the valuation in startup is quite crazy, in the sense that it's not the same as it works for valuing mature businesses. Sometimes when you hear, oh, this company is raising at 100 million and they have not generated a profit, you are wondering, how can some people invest in something like that? But again, this is the way it is. If you don't get it, forget about it, like they said. So most company valuation don't work for startup, because again, they operate in a very special place. And then different investors tend to use different methods. Most of the methods are based on simple rules of thumb or experience. And valuation in general are subjective, but ultimately the value of a company is what somebody else agrees to pay for it. It's as simple as that. And again, it varies by location as well. So for example, startups in Nigeria tend to be way cheaper than the valuation of startups in the US or Silicon Valley, for example. And it also varies by the experience of the founding members. So if they are like serial entrepreneurs, maybe they've had 1 or 2 exits in the past, the valuation tends to be higher. We'll look at some other determinants as part of this presentation. So again, as a rule of thumb, as a general rule, the more progress a startup makes, then the higher the valuation. Some people are coming in. I'm just going to admit all. So moving on. All right. So I was talking earlier about what justifies, the valuation. Why are some companies have a higher value than the others? Again, as you can see here, you have different types of businesses. So I'll go with the lowest one, which is what people call lifestyle businesses. So these are businesses that, maybe makes enough money to take care of you, your close ones, but they are not like investor grade, because investors will not see good returns. So their valuation tends to be quite low. Then you have tech businesses that is starting from nothing. Their valuation tend to jump over time. So when they meet certain milestones, maybe it's milestone in terms of whether they've launched a product, whether that product is now being used by customers, whether they have customers that are paying for the product, whether they have the right team to execute. So there are different criteria that they meet, and the valuation tends to just jump. And generally, most tech businesses don't generate new IP. Most of them just write codes to do things or to take advantage of a gap that's in the market. But you can also have a tech business that has an IP. This is also common. So it means that the moment you have the intellectual property, the valuation jumps right away off the bat. And again, it's very similar. Jump, 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 you see. So these items on the right are determinants of value. So for example, do you have a founding team, and what sort of experience do they have that will impact on the valuation? Do you have like board of advisors, like non-executives that maybe they've done something similar at a larger scale that also help. If you have, of course, if you have a patent, that always help. You have a proof of concept or prototype, which is a minimum viable product, or you have some strategic partnerships, that's good. If you've proven the market, that's also a good sign. If you've done a beta test with beta and they have given very good feedback, or you have early customer traction, or you have grants from organizations that are reputable. Maybe you get a grant from the World Bank. Investors will think, oh, if you are able to get that, then you must have something good going. So those things can affect value. Also, if you've done a seed round, maybe you have some top venture capital firms participating. Again, these are things that really, really, really help. So I'm just going to move on to another item that relates to that, which is really breaking down the subject of valuation. We are all engineers here, so valuation is a very simple calculation. So what you have is there's a pre-money valuation. It's what the company is worth before you seek additional investments. Post-money valuation is what the company is worth after the money, the external investments has come in. So, and to determine the valuation is a simple calculation, as I have on the screen. Now, I'm just going to show one example. Apologies to those experts in maths that this is really, 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 really so simple. So the example is an investor offers to invest 100,000 for 25% stake in your business. What is the pre-money valuation of the business? So the first thing you do is, what's the post-money valuation? You invested 100,000 at 25% ownership stake, which means that the post-money valuation is 400,000, and then the pre-money valuation is simply the post-money valuation minus the investment of 100,000 that came in, and that is 300,000. Why this is quite important? When investors are talking to founders, they tend to go with the concept of post-money valuation. Again, it's one of those things in the industry that they use to confuse founders to get more stake in the business. So if the founder is not thinking about this, so when a VC tells you, oh, so the valuation is 10 million, right? A founder should go, oh, are we talking about pre-money or post-money valuation here? Because it's actually quite important. VC tend to talk about post-money valuation all the time. And if you get it wrong, you can see that it's going to be given significant more equity away than was planning to. It's just for one of the tricks of the trade. All right, now let's start to look at some benefits and why we should seriously consider this particular asset class. And it's really to look at the way the valuation grows over time and how often startups tend to need money. Now, if you've spoken to, you probably would have heard from people who say things like, oh, when you invest in a startup, your money will be diluted. At the end of the day, what are you going to get? You have this sentiment around. While it is actually true, and you should be very, very careful when you're investing in startups, especially tech startups. So there are things that you want to look at when you're investing in tech startup. One is, how quickly are they growing? Because the faster they're growing, the higher the valuation multiple you're going to get. And as long as they're growing and you're getting the right multiple, then even though you're being diluted, there are things to do to prevent the dilution. That's number one. But the overall value of your stake will continue to increase. So we look at the example on the screen. So at seed round, let's say that somebody invested £1, okay? The total round is £2, okay? An angel invested £1. 9 months later, they're doing another round, and this time the valuation is around £6, okay? Which means that the person that owns 50% of previous round, which is £1, that £1 is now worth like £3, even though is going to be diluted because new money is coming in, the overall size of the stake is increasing. Now, this is a really crude example, but if you get really great companies, you'll see valuations growing in orders of magnitude. I'm talking about over 10x within a 1-year period. So you have a company that's valued as 1 million today, and then 1 year later is valued at 10 million. So you can imagine how good it can be when that happens. Now, I said earlier that you can actually defend yourself, ways to defend yourself from dilution. So when you're investing, depending on what sort of influence you have on the company and on the founders, you can have anti-dilution clauses, which will protect you from dilution, which means that when they're doing the next round, they have to tell you how much more you need to invest in the business to keep your stake from being diluted. That's number one thing you can do. Number two thing you can look at is secure pro rata right. Pro rata right simply does the same. It means that as long as the company is raising funds, you want to have the right to participate in future round to maintain the percentage holding that you have. All right, now I'm just going to talk about the different stages of funding and why, what companies try to achieve. So first, a founder or co-founders have an idea. They need some pre-seed funding. Pre-seed funding is what they usually will use to either develop a minimum viable product, which is the basic minimum they actually need to do to be able to release something to market and check whether, okay, this our idea or our thesis, there's actually a market for it. So they take the pre-seed funding and they develop a product or service, usually a minimum viable product. Now, once they launch that product to market, if the product is doing very well, then they go to investors and they raise a seed capital. Now, seed capital can be maybe from crowdfunding, can be from early stage VCs, can be from angel investors, and can be from a syndicate of investors. And usually what they want to achieve with the seed capital is to improve the quality of the product, to improve their message, their marketing plan, and to achieve what we call in the industry product market fit. Now, product market fit is that point you get to in the life cycle of the business where that business really takes off. It means that you've achieved a balance between what your original idea is and what the market is expecting. Just to give a general example, you may have a thesis that, oh, if I create a taxi, a Uber, I don't know why I keep using Uber. If I create a Uber type of application and I launch it in Nigeria, then people will use it. Now, this is actually a practical example because I've been using Uber for a long time. I use it when I travel anywhere in the world. And then when Uber came to Nigeria, and I used Uber in Nigeria, it was actually quite good. It was similar service to what I've enjoyed in US and in Europe. But then a few years later, I used Uber in Nigeria and it wasn't as good. The quality of the cars have reduced and all of that. what am I trying to say? Uber has a thesis that works in developed countries. You know, the cars are always clean, neat, and all that. Then they came to Africa, and then in Nigeria, as an example, they have to start reducing the quality of the service because one, there's issue of affordability. Two, there is competition, and then they just have to do something different to achieve a market fit for the new environment. And one of the things they have to do to achieve the market fit is to start accepting cash payment. I mean, the whole point of Uber's original thesis is you can go into a car, have a ride, walk away at the end of it. Now, if I had to start talking to the driver about giving him money and collecting change, how is that different from the original taxi business? But again, it's about different markets and achieving that product market fit. And that's what they had to do in countries like Nigeria. They had to accept cash because most people just use cash. All right, moving on. Then after achieving that, you go for a Series A, which is where you really start to scale. So they've done this in Lagos, it works. They've done it in Abuja, it works. They've done it in Port Harcourt, it works. Now, rather than just go to Ghana and try to do it again, they say we want to go to like 10 African countries and replicate the same. So they need to raise a Series A and then continue to charge growth. So, and after Series A, we go into what they call late stage, where you start to talk of Series B, C, D, F, and then there's an IPO or some other form of exit event. Now, where do we come in here? Somebody's probably asking, well, there are different stages and opportunities to invest in the life cycle of a company, and there are mechanisms that allows investors, especially accredited investors, to participate. So one is the crowdfunding. Two, you can join a syndicate. Three, you can sign up and subscribe to a fund. Four, you can subscribe to a fund run by a syndicate or a VC. And then usually the syndicate or VC that you're joining will tell you what their investment thesis is, what type of companies they like to invest in. Some will say we are focused on only SaaS company. Some will say we don't care, we do all sort of companies. Others will say we only focus on early stage. Some others will say we do late stage. Others will say we do both early and late stage. You know, so you now need to think about, I'm going to talk about, portfolio approach and how to achieve what you want in terms of balancing your overall investment objective. All right, moving on. So I mentioned just earlier about portfolio discipline, and I thought it's good to mention that when you're investing in a startup, which is a high-risk asset class, it's important to have a portfolio approach. What that means is you don't invest in one company and then, just sit down that, okay, I've done it. You can be, extremely fortunate or lucky, as some would say. And the only company you invest in as a startup turn out to be Uber. Those that invested in the early stage of Uber, by the time Uber was doing an IPO, they got 18,000x. So it means that if you invested $1, by the time Uber was doing IPO, you're getting $18,000. So made a lot of people billionaires, basically. But again, those are really, really rare. And what the history has shown is that nobody can predict the future. Even the top investment VC firms like Sequoia and the likes, they have what they call anti-portfolio. These are startups that they thought would never work, that turn out to be a great success. But one thing everybody does that sort of help to achieve the overall objective is to have a portfolio, which means you're not investing in one, you're investing in a range. So when I showed my portfolio earlier, you can see that I invested in quite a few. Actually, that's just a subset. I invested in many more. And, you know, as I said, some of them would die, which is expected in this asset class. And some of them will do very well. And at the end, overall, you'll be very good. And this table just illustrates that. So what I've done is I've put a simulation together of a portfolio of 10 startups with an investment of $1,000. Actually, you can invest that low in startups, $1,000 each in each one of them, totaling about $10,000. So I simulated that, okay, if the first one gives you 50x, and this is very, very possible, and then the next one gives you about 20x, the next one gives you about 10x, the next one gives you about 5x, and then from the 7th to the 10th one, you completely lose your money. Maybe on the 6th one, you just got your money back. What does that look like? Then your 10,000 would have become 88,000, giving you a portfolio return of 8.8x. Now, if you're connected to the right syndicates or VC, you can tend to catch those ones that will give like 100x and above, because they do, they have a lot of visibility. So the top companies want to go to them, so they get far more deals, and you know the likelihood of them succeeding is very high. It's a winner takes all kind of scenario. So that's the whole idea of, you know, going into startup is not about, oh, I'm going to invest in one company and then you're sitting, you're waiting for the returns to come. Actually, these investments are something like you do, and then you just completely forget about them. You know, some of them will send you like monthly updates. Some of them will send quarterly updates. Some you just don't hear from them at all. It doesn't mean that, you know, something is wrong, but then you just hear that, oh, they just raised a round. Like I had the pleasant news with Plaza. When I invested in Plaza, they were at a valuation of $70 million. And then just about a month ago, they did a round and they crossed the $1 billion mark. I was like, oh, wow. So within 2 years, they've gone from 70 million to $1 billion. That's, you know, a really good one. So, and I never heard from them for the last 2 years I invested. You know, I didn't know what was happening, but this is the nature. So you put it in, you go to sleep. And also it's been suggested that you should never invest more than 5% of your net worth in this kind of risky asset class. So you must invest something that you just do it, expecting that at some point in the near future, you see a good, sizable return. Also, it's good to mention that when you invest, especially at the early stages, it can take between 5 and 10 years to actually see the returns. I think this is quite important to mention. It's not the type of investment you do expecting, you know, regular cash or dividend or those kind of things. No, you expect multiples of what you put in. All right. I thought I'll cap it or end this by talking a bit about Phronesis Capital, which is the VC company founded by myself and a couple of others in this group. And just to take you through what the process looks like, some people in this meeting have invested with us in the past, so they're familiar with this, but I'll just explain it so that you can understand what the investment process typically looks like. So first, what happens is that the syndicate lead, in this case, with Phronesis Capital, we do a number of things to attract founders, basically. So we use our network, we leverage people we have invested in previously. We just, go to startup meets and, keep our heads close to the ground, listen to relevant podcasts and subscribe to relevant newsletters. Just have a basket of leads from all sources, and we listen to founders all the time. And for those that we are interested in, we would seek to form a group, which is what we call a syndicate, to join us and invest in it. And what will happen is we'll set up an introductory call with the syndicate. We'll also have introductory meetings with the founder, where the founder will pitch to us and we will look at it. We'll critically decide whether this is something that we, as partners in Phronesis, want to put our money in, because we don't bring any investment that we don't invest in as a principle. So if the founder and the opportunity passes that test, we will then invite the founder to come and pitch to the group that we've put together. And once they pitch, like we had one recently for YouVerify, people in the meeting will have opportunity to ask questions. And once all of that has been dealt with, we move on to provide information on the participation terms. The participation terms, I have a slide explaining what a typical participation terms look like next, which I'll explain. And then those that are still interested will make a commitment. They'll complete a form to say, I'm interested, this is how much I'm thinking about investing. This is actual commitment, and we expect that people should only commit when they know that the funds are available and they'll be able to deliver by when the funds are needed. Now, of course, we will do a due diligence. We normally do the legal side of things, where we check the ownership of the company structure, and all things regulatory related. And then with the financial due diligence, in which we get a finance consultant to look at their books, look at their numbers, verify that what the founder is telling us is actually true and an accurate reflection of reality based on what is it in their bank account and what they have on their books. And once that has come, usually we've not had a situation where it's come with significant reservations. Sometimes there are open questions which need to be dealt with. But if we find red flags at that point, we will dissolve the group, we will stop, we will not go ahead and invest. But if everything comes clear, maybe with some minor reservations, we will seek to clarify that. And if those things are clarified to our satisfaction, we will then go on to seek the financial contribution and then set up the SPV where all the investments will be held, and the members participating in the syndicate will have shares in that SPV. And the final step will be to close the deal, where everybody signs the relevant documents and they get their own copies. So that's a typical flow for investing in startup, and we follow that standard flow at Phronesis Capital.
Hello, Debo. Sorry, a couple
Yes.
of people are waiting to join the meeting.
Okay. I've been admitting people actually. Okay. So I think 2 people just entered now. Okay.
Thank you.
You're welcome. All right. So there's one more slide. Just excuse me. I think it must have been hidden. Yeah, that's why. I will just unhide and show you the slide. All right, sorry about that. So this is just showing what a typical deal will look like. This is for one of the companies I invested in, so for confidentiality reason, I've blocked it out. And these are the key terms that I'm just going to be talking about. Oh, sorry, my bad. All right, so the round, this is a Series D, so it's after Series A, so it's a late stage deal. They're raising as equity, 60 million is the amount of money they're looking for. They're raising as equity. Another option is a SAFE. I probably should talk a bit about SAFE. A SAFE is simple agreement for future equity. What tends to happen is when a company is trying to raise money, they need to identify quickly a lead investor. The reason for that is the person that puts the most money is really the person that determines most of the terms of the deal. Imagine if you're raising 60 million and you haven't identified a lead and you have to be agreeing to terms from anybody trying to give you $500,000, that will all be a mess. So usually you raise equity once a lead has been agreed. In fact, the lead determines the valuation that is negotiated, and they will typically take anywhere between 10% of the deal to maybe more than 50% of the total round. And of course, if somebody is giving you half of the money, then other people have to fall into their terms, basically. So in that case, you can quickly raise an equity round. Another option, which is now more common, is to raise what we call a SAFE round, which I explained earlier. It's simple agreement for future equity. What that means is you're going to be participating, but you don't know what the valuation is going to be because a lead has not been identified. So what happens is you then agree a cap to the valuation. So you agree something like, okay, this company should never be valued for more than 10 million. If it is valued for more than 10 million, then convert my equity at 10 million. That's the way a SAFE work. Or they say, whatever the valuation is achieved, because I'm investing early, give me 20% discount. So if they value the company at, let's say, 8 million, you can then get a 20% discount and then pay, if my math is correct, 6.4 million valuation. So that's why SAFE is very common now, as you know, money in the world has really, really increased. There's so much capital chasing very few deals. So getting that lead position has become even more tricky, especially for a good deal where people start to compete to be the lead. It can take a while to resolve that. And that's why SAFE is becoming a more common approach. Of course, the valuation before funding. So this clearly states a pre-money valuation of 298 million, which means that the post-money is going to be about 358 million based on the calculations that we did earlier. 1 second, I just need to get my pointer. All right, the next one is the anti-dilution provision. I mentioned pro rata right. It means that in this deal, pro rata rights are not included. And it is actually quite common for late stage deals that you're not getting pro rata because at that point, the valuation has gone so high. So it's 298 million, it's quite high. So it's not that important to have pro rata right at that point, but pre-Series A, pro rata right is actually quite a good thing. Allocation, this means that for the syndicate, out of the 60 million, the founder has given them $403,000. Estimated costs, or sometimes called administrative costs, is what you pay to set up legal, to do due diligence and stuff like that. This is 1% for this particular deal. Sometimes there's a management fee as well. Typically 2% for management fee, but that's not included on this particular deal. Then the syndicate lead is telling you how much they have invested. So they've invested, in this case, $5,000. The carry is usually a subject of interesting conversation, I would say. But the carry is for the syndicate lead, bringing you a good deal, having a relationship with the founder, maintaining that relationship throughout the life of the deal. What they get in return is a carry. In this case, the standard industry carry is 20%. Now that 20% is 20% of the net profit that the investor make on the deal. Let's say, for example, you invested $1,000 in a deal. There's an exit event, that $1,000 becomes $11,000. Okay? In that case, your profit is $10,000, and the syndicate lead will get 20% of that $10,000, which is about $2,000. That's the way it works. And my friends, that is the end of the presentation. I'll open the floor for questions or comments. Thank you.
Thank you very much, Debo. That cannot be more succinctly about that. Pardon my teeth. Now, I think that's a very interesting session, and I hope people are able to follow through the session. A lot of interesting stuff was said, and I can see a lot of people that are already investing in the house. So I don't think I think some people are already familiar with this. I can see a lot of new people. Let's go straight to the question and answer session. I can see Nika is already asking a question. Nika, do you want to ask your question directly, or you want me to read? Okay, let me just read. She said, I once tried to set up, pardon?
Please go ahead and read it.
Okay. I once tried to set up an investment club in Nigeria, but the challenge was working out how to pay investors. We were unfortunately advised to register. Can you share how Frenzy is able to?
Sorry, please read the second one. I had to type it twice. There was a mistake in the first one.
Oh, okay.
Sorry.
Okay. She tried registering an investment club, but the challenge was how to pay investors. We were unfortunately advised to register as NGO. Can you share how Frenzy was able to deal with the issues of paying investors?
Okay, this is a forward-looking question for us. The first thing I'll say is we've not had an exit event yet, so we've not had this problem of paying investors. But I reckon we are not going to have that problem. And the reason I say that is, so there are two main options when you're setting up a syndicate. So one option is to set it up as an incorporated entity, okay, which is maybe a limited liability company. So it's incorporated. You can also set it up as an unincorporated entity, okay? Now, what we did was to seek legal advice from a law firm that is very experienced in this space, and they guided us every step of the way. So basically, if you have an unincorporated entity, it means that the investments are in the name of the individuals, and once there is an exit event, you already know what their share of the investment is and their return, and you can just simply distribute. Maybe there is more to your question than, you know, Nika, do you want to really
Debo, I think you're already beginning to hit my point anyway, which is we didn't want the case where we needed people to trust an individual with their money. We wanted something formal that would ensure that everyone knows that their money is safe and it's not based on an individual. But unfortunately, I think we got wrong legal advice on how to incorporate. I think what you said about being us even incorporating as a limited liability company would probably have been better for us if we wanted to go with the incorporated entity option. but unfortunately we got bad advice.
Yeah, sorry about that. And I think, you know, the first thinking is you want to go for the incorporated entity, but actually there are a lot of benefits to the unincorporated entity as well, especially the reporting requirements that is going to be necessary with the incorporated entity. So you need to file annual accounts and annual returns, which is a lot of
Exactly.
administrative overhead. But if you go with the unincorporated entity option, then you can avoid all of that.
All of that.
Everybody still signs, everybody still know what their shareholding is. But my best.
Okay, so when you say everybody still signs, they're going to be like an MOU, as in how would that unincorporated? Maybe I need to talk to you privately.
Yeah,
Yeah.
let's have a chat privately. But I would recommend you talk to the people that work with us all the time. They can give you better advice than I ever could. They advise us, and we've done this for I think 3 deals already, and we've not had any issues.
All right.
Yeah.
Thank you.
And more so, most of the tech startup investments are dollar denominated and not local. So most of those transactions are even done through a Delaware entity. So therefore, it doesn't follow the rules, all the local rules in Nigeria.
All right.
I don't know if there's any tech up. I don't know if there's any tech startup in Nigeria that is collecting, raising funds, and I doubt. Debo, any idea?
I've not seen one actually. All of them tend to do valuation in dollars and do investments in dollars, and for good reasons as well.
Yeah, I can imagine. I can imagine. Thank you.
You're welcome.
So the next question is from Akim Salam. Does Phronesis invest in estate technology as well?
The answer is yes. We do invest in tech startups, whether it's estate tech or agri-tech. If they've got things that is quite interesting and they meet our investment criteria, we will be happy to consider them. I mean, Kunle, you can also chip in on that. You're a partner.
Yeah. I'll say I came in camera to give him all the lowdown he could ever want.
Okay.
Yeah. So there's another question from Script Solution asking, are there statistics on Nigerian companies, their performance and their investment performance? And 2, does your company invest in Nigeria companies only?
Okay, let me take the second one because it's more straightforward and easier to respond to. So so I and Taiwo, we've been investing in startups for some time. And one of the things that we saw that started to happen is that the innovation from Silicon Valley started to spread all over the world. So you have pockets of tech startup in London, in Berlin, South Africa, Kenya, Lagos, everywhere. And what the folks in London investment circles and Silicon Valley investment circles started to do was directing a lot of capital to Asia, Latin America, and Africa. Now, if you think about the slide I showed earlier, showing all the top billionaires in the world and how they've made most of their money in tech startup, what you find is that in the next 10 years, in the next 20 years, if we're not careful, Americans, Europeans are going to be the owners of the tech giants that are evolving in Africa. So you have Flutterwave that just crossed the $3 billion valuation mark, and if you ask who invests the most in Flutterwave, it's the Americans. But this thing started in our backyard. So one of our theses is, okay, this thing is happening. What can we do to leverage our positioning and to take advantage of what is going on out there? So we specifically set up Phronesis Capital to really give opportunities to invest in the African scene by inviting people of like mind, like people in this group, like Nigerians in diaspora. Like, we cannot let this happen. It's going to be like another slave trade where all the top deals, all the top companies will belong to Europeans and Americans. And this is one of the founding reasons for focusing on Africa. Of course, at some point when we raise significant amount of funds, maybe we will need to chase deals elsewhere. But primarily, we like to see good things happen right across Africa. And we're not the only ones doing this. We have venture platform and some other folks doing something similar. We're just joining that train to make it happen. And I think it's a noble cause. Now, your first question, are there statistics on Nigerian companies, their performance and their investment performance? Your question is a bit, difficult to answer. I don't know whether you're talking about maybe returns on investment or whether you're talking about how those companies are doing. So I'm just going to try and answer on both fronts. So in terms of data on how they're doing in terms of investment performance, well, most of these companies, believe it or not, are actually headquarters either in London or in the US. The vast majority are headquarters in the US, and in the US there's data. So if you dig through the right sources, you will get data on how much they are raising and how they're doing because of regulatory requirement and reporting requirement there. In Nigeria, not so much, but things are improving at a very rapid scale. I was talking to a friend of mine recently, and the friend was telling me that, look, the Nigerian tech startup, they're operating on a lane. The Nigerian government, they're operating on a separate lane. They are not meeting. Of course, there's a startup bill that they're working on, which hopefully will start to bridge the gap. But the guys are making things happen, and they're doing well. And you have some notable examples. You have the likes of Flutter with Paystack. You have some of the new banks, and there's so many companies that are doing very well. But our data might be quite difficult to put a hands on, especially because most of these companies are private companies.
Okay, thank you very much for that answer. Michael Olaoye says, amazing work, Debo, as always. You make us proud as you shared investing in a portfolio of startups is the key and not in investing in a single one. The question now is, are you looking into having a fund which invests into different startup portfolios?
Yes, the answer is yes. That is the goal. We started not too long ago. We're doing the third deal now as a company, and what we will be looking to do is to raise a fund so that we don't have to go into investors all the time. We can just invest in deals. Some deals that are very good needed to be closed quickly. I remember when we were doing Trove, right in the middle of deciding to invest over a 2 weeks period, the valuation jumped significantly from about 8 million to about 15 million. Why? Because some people just came from the US. They said they don't want to do any due diligence. They just gave them money, take it after the round has closed. And the investors and the founders had no choice but to raise the valuation to be the valuation for the next round. So if we had a fund, we would have been able to do more. While we're still trying to gather a syndicate and do stuff, valuation jumped. So the goal is to create a fund on a rolling basis so we can be investing on a portfolio basis for our investors and of course for Phronesis Capital. Thank you. And thanks, Michael, for the kind words.
Okay.
Hi, Debo. Can I ask a question?
Yeah, Yemi, please go ahead.
Okay. Good evening. Thanks for the very interesting discourse. I joined late, very late actually, but I know I still got some
Sorry,
very,
hold on, Yemi. Debo, you can please scroll through the slides for those who came late. I noticed a couple of people came in late, so they can also see part of the other slide. So, Yemi, you can go ahead.
Okay,
Thank you.
So again, thanks so much. I think this question I've asked it before, but I just want to ask again, right? And it's just because of something that keeps going around in my head. Like, so the venture capitalists and syndicates, right? Will they be involved in decision making, right? For these tech startups, having put in so much money, investment? It's a question, right? And I'm asking because of a potential abuse around scaling up businesses, with zero liabilities, right? Because I mean, I don't think the tech startups, do they really they're not liable, right? If the business doesn't crashes or if something happens. So, I mean, I'm just imagining a situation where VCs and syndicates are putting a lot of money into these startups. And the startups themselves probably have zero liabilities, or maybe it's very limited liabilities to the additional cash being doled out to them. So will they be involved in decision making just to be so that it doesn't get into a situation where people are just planning to scale up just because they want to get money from outside or something?
Yeah. So Yemi, that's a great question. I'm going to answer it from perspective of a VC leading a round and other VC maybe just participating at a very low level. Now, for VCs leading a round, there are two schools of thoughts, okay? One is we are leading a round and we are going to be heavily involved, okay? The other is we are leading the round. We are here. If you need us, we can support you with whatever you need, but we are here, So which approach is the right one? Both have been found to have positive and negative consequences. A case in point is WeWork. WeWork was given billions by SoftBank, and the founder was doing anyhow, private parties on private jets, weekend parties and all sort of things. And the truth only came out when WeWork was going to do an IPO and serious investors started to look at what was going on in the company. And it became this poster child for bad behavior in a startup. But it was SoftBank that gave him money and he abused it like that. I mean, the startup with a private jet, that's quite something. But at the same time, you've had situations where the VCs give you money and they want to control, they want to be part of major decisions and all of that. And a good example of where that has not worked out okay is Apple, when Steve Jobs was, pushed out of the company. I mean, Steve Jobs has a lot of negative things. He was young, he was brash, he had attitude problems and all of that. But he has thought longer and harder, more than anybody else in the company, about where he wants Apple to be. And that is why, until he came back, Apple was nowhere. So some people already also have that belief that, founder-led companies, it is their idea. They know what they're doing. They started the company. If there's anybody that can make it work, it is them. So let's just give them space and let them do what they do best. So the two. And then the issue of, abuse is then down to individual in that case. If you want to misbehave or misappropriate investor resources and all of that. But then how do you know what is misappropriation or misbehavior? apart from the WeWork example, which is quite glaring. I mean, if I'm a founder, for example, and I may decide I want to spend 100 million on a TV advert. So a VC representative of the board may say, well, that's a waste of money. Yeah. So how do you determine, yeah, is it possible to mute that person? Can people mute if you are not speaking, please? All right, so how do you determine, you know, really requires, okay? So it's actually quite difficult to judge until you see the result. When you see the result, and the result can go either way because it's about placing bets. Now, the other aspect of your question is, okay, if I'm investing in this, how do I protect my funds? And the truth of the matter is, it depends on the level of investment you have. Typically, if you are not taking up to 5% of the company, you are unlikely to get a board position. And even if you have a board position, by the time you are doing the next round and your value, your equity is reduced, you can be kicked out because there will be new board members. So you then have to depend on the fact that the lead investors have the right approach in terms of oversight to ensure that their own investment, which is the largest, and other people's investment can be protected. But yes, there are structures to achieve that, you know, through reporting requirements. So they have to tell us what's going on. Depending on the level of participation of the VC, they can send in auditors from time to time to check and verify things. So there are a whole range of governance arrangements to keep the startup in check. But you know, you also don't want to interfere with the day-to-day activities where they are doing the right thing. Other services that VC provide includes recruitment, you know, sales connection, marketing connection, even hiring. VCs now have all these departments doing those kind of things just to support their portfolio of startups. Yemi, I hope I dealt adequately with your question.
Yes, you did. Thanks. Thank you.
You're welcome.
Okay, thank you, Debo. That was that was a very detailed explanation. Are there any other questions, please? I'd like us to round up in the next by 9:30. So any other question?
Maybe I should just ask pre-seed investment or pre-seed rounds or something. Is there any place where information is available on those kind of things? Because, and also, does Fluency have pre-seed round investments in their portfolio, or are they looking into that direction, or is it like high risk or something?
How do I answer this question? So the names, you know, keeps changing over time, and sometimes it varies startup by startup. So what some startup used to call a Series A, other startup will call it a seed round. You know, the concept of pre-seed is actually fairly recent. You know, like you have an idea and you want to put together a product, and then you raise a fund. Maybe it's the same as like an angel round. Okay, so you can call it a pre-seed. It's just nomenclature, really. Now, the earlier you invest, the higher the risk. Okay, and it's so interesting because those that invest at the late stages, okay, their risk is lower. So especially if you, I like to say that the sweet spot is Series A, because at Series A, they've achieved product market fit and they're just scaling. So what is already working, they just want to scale it. So that's like the sweet spot. But then again, if that is a sweet spot, then there's a lot of competition for that deal. And what happens is you may not be able to get in. So a strategy is to go earlier, which is, take more risk and then try to negotiate like a pro rata right, which allows you to invest up to Series A, to make sure that you are not diluted. So going earlier is actually a strategy to be in the game so that if the company does well, then they can't say, oh, those of you that helped us when we were nobody, now we are grown up, we don't need you anymore. So that's the benefit. The other thing is, the earlier you invest, the higher the rate of return by the time an exit happens, okay? Because when you're investing in that stage, the valuation is much lower. Let's say, for example, at this stage, you can have valuation in the range of like $1 to $5 million, depending on the quality of the team, the market opportunity, how far they are with the product development. And here at the seed, you will be having between maybe 5 and 10 million. This is just typical numbers. Some can be widely out of that range. And by the time you're doing your Series A, you're looking at valuation in the range of about 40, 50 million, and you're raising like 5, 10 million. And by the time you go to the late stages, that's where you're talking about valuations in excess of 200 million, 500 million, even billions. And you're raising funds commensurate to that. So Phronesis, we will focus, I say we are focused on from Series A backwards, because after Series A, it just gets too large for our investment to make much sense. But again, we understand the risk of early stage. So if we're doing early stage, there has to be something really, really interesting. Pre-seed, there has to be something really, really interesting about it. I don't know if Kunle or Taiwo is in the meeting, they can say something, because we're all partners in Phronesis.
Yeah, I think you covered everything, Debo.
Yeah.
Can you hear me, guys? We usually just go below Series A. We try to look at the seed level, because at that point it's going to be post-revenue, which help us understand what the direction of the company is going and all. We've not done much of the pre-seed, but I think we'll start looking at one or two. We've done one, I think, one or two. We've done one or two, but we're looking at a bit more there, because that's where you can get more return on investments. Although it's high risk, but you get enough return there. That's where you can get the big X. Yeah, so yeah, we're always at the seed side, really.
Yeah, thanks, Taiwo.
Okay, thank you. So, Debo, I think we can't live without talking about YC.
Okay.
Yeah. So I need you to just talk a little about YC, shed more light as in, because that's like the ultimate destination for most of these tech startups. So we need to discuss it.
Okay. Let's talk about a bit about YC. YC is Y Combinator. They are an accelerator for startup. Maybe I should have had a slide to talk about what an incubator is, what a startup accelerator is. So YC is a startup accelerator. Basically, what they do is they take companies and they provide them with tools, connections, and network that can help them accelerate their growth. To qualify for YC, I think their success rate is about 2% or something like that. So only 2% of all companies that apply make it. Now, the reason YC is quite popular, by the way, they're not the only one that do what they do, but YC were the first to produce a significant number of companies that have achieved unicorn status. That's why they tend to be talked about a lot. And also recently, we started to see a lot of Nigerian companies making into YC. So think about YC like, oh, you get in, you can easily get investment from American investors, because one of the things they look at is, oh, to get into YC is a big deal, so you must know something. And that sort of helps to lower the threshold of what they are needed to do in terms of whether they should invest in you or not, because you have the YC label. Now, you know, you have companies like Dropbox, Airbnb, those are like their poster companies that have come out of YC. They've achieved a lot. Now, YC, what they do is they take, I think it's about 6% equity in your company, and then they give you, I think, about $150,000 or something. Not a lot of money they give you for that equity stake in your company, which is quite a lot to give, but they take you through an intensive program over 3 months. They help you, work with you to refine your pitch, and they have a number of investor days where they invite VCs and other people within the industry to come and listen to you pitch. And in fact, what tends to happen is before that demo day, you start to get a lot of investment offers at a significantly higher valuation than what you had before joining YC. Recently, they changed their approach where you're getting the 150, no, was it 125,000, I think, and then after completing YC, they give you another 375,000, but this time at the valuation that you achieve post YC. So the reason they've done this, just this year, they started that, is sometimes, you know, the YC companies tend to be forced to accept a deal because they are running out of funds. So they just give them about $375,000 or thereabout at the prevailing valuation after YC. I didn't prepare to really talk about YC, but I think that sort of captures the main essence of it. Kunle, I don't know if you want to add a thing or two to that.
I just want to open to stir up people's curiosity about YC, because YC will give you more understanding about the tech space and what is happening there. Okay, so let's just move on, because I would like us to just round up so we don't take too much time. Thank you, Debo. Lovely presentation. Though I joined late, can you shed more light on how Bitcoin investment works? I've heard a lot about people losing money and how safe Bitcoin is. That's from Michael Alumona.
Oh my God, Michael definitely must have joined late.
Very late, yeah.
Yeah. So this is a slide that you probably saw. How do I say this? So this slide is just saying that, you know, people can invest in many things. Okay, real estate, stocks, commodities, gold, artworks, cryptocurrency, mutual investment, and startup. And then the focus of this presentation is startup investment. I did not talk about any of these other asset classes, just mention that these are different things that people invest in. But I think everybody should also seriously consider startup investments. And the reason is, I showed this slide, that most people say that, oh, the richest people in the world make their money from technology. But actually, it's not just from technology. They make it from the technology companies that they founded, so from tech startup. And then that's your Forbes list right there with all the different people. Now, just to say something about Bitcoin, it's also something, I hold investment in cryptocurrency personally. I think you have to be careful with any investment at that. So it's not something that I cannot recommend investment to you, but I can give you information, okay? Cryptocurrencies or Web3, as the case may be, is going to be way bigger than it is right now. That's my personal belief and understanding. It's going to be bigger than the internet, okay? And everybody should pay attention to what is happening in that space. Right now, we may be in bubble territory, okay? This may be 1999 of the internet bubble. Maybe that's where we are with cryptocurrencies. But we should not, because of the bubble, shy away from the fact that, hang on a minute, there was tech bubble in 99, but then you had Amazon, coming out really strong. So there's going to be some winners. There's going to be many losers. And we just need to pay attention and see what is going on there. I personally think that Bitcoin will continue to grow because of the scarcity element. It's limited supply. So the value will continue to increase. And if you think about what is happening in Russia, Ukraine today, our thoughts are with the people of Ukraine, because the war is completely unjust and unnecessary. But one of the threats, one of the sanctions against Russia now is they're beginning to remove their banks away from the SWIFT system, which is actually quite powerful. And to think that in 2000, from one country to another, you have to go via this antiquated system. Is actually quite bizarre. When I can send an email or a WhatsApp message to you right now, but I can't send you money like that. And that's one of the main applications of the cryptocurrency or the blockchain technology. And it's not going away. It's actually the next big thing. We just need to sift through the noise and focus on the right ones to invest in for the long haul, because many billionaires are already been minted. There will be many, many more everyday people that will be billionaires because of the blockchain technology and cryptocurrencies in general. It's not investment advice, please. Seek professional advice. It's just information share. Thank you, Michael.
Yeah. Okay, thank you very much. Squid Solution is asking about incubators and accelerators. I think this is this has been handled. So we just spoken, and people just spoke about that. And I think at this point it is safe for the ship to dock here. I want to thank everybody for participating in this tonight. So I'll call on, I don't know if Nika is still on the line to give the vote of thanks. If not, I'll call on Yemi. But before that, let me just mention to everybody, April 2nd, we are going to be having another session with Dr. Akintoye. That is the chairman of Platform Capital, right? He's also into all this and a lot more. I think their company invested in over 20 something companies in January alone, January 2022. So they have deep pockets. They'll be talking to us on April 2nd. And he's also the chairman of the company that renovated BOC, all those pictures we saw about OAU. That's the man behind it. And he's been provoking and challenging people about how we all owe Nigeria, rather than thinking Nigeria owes us. How all the education we got from this company are things we can't even get out of it for free out there. So make it a date with us. So at this point, I want to call on Yemi Olagunju to give the vote of thanks.
Okay, thanks, Mule. On behalf of everyone on the call, on behalf of the faculty at large, and everyone that has been in, we've been in touch with each other, especially via the WhatsApp platform. So I want to say a big thank you to you, Debo, for honoring this invitation to speak to us. I think we only just reached out to you probably less than 2 weeks ago or something. So, but we knew that all along that we're going to get a lot of value from having you speak to us because of the experience you have. And very many thanks for all that you've shared. I don't know how much we would have had to pay if we had gone for some external, experts to come and talk to us about some of these things and, some of the nuances, the unspoken things and, so many things that you actually covered. Like I mentioned before I joined late, but even for the short period I was available, I really got a lot. And also the recording, which will be available not just to those of us that are online now, but also to those that did not join, will be placed on the faculty group. So it will also be of value to so many more people than you have seen on this call. So thank you very much. Phronesis is open for as many of us as are interested to join, right? I think I've also been a part of Phronesis in terms of investing with Phronesis for a period now. And of course, those investments, we're still looking, they're looking positive. And we cannot prejudge how they're going to perform at the end of the day, but this is an area where a lot of people are really making money worldwide, right? Not the normal 8 to 4 kind of work that we all maybe typically do. So thanks, Debo, for the time. Thanks for the effort to put together all these thoughts, which I know they were all in your head and you just put down. And thanks to everyone also who is still on the call after 1.5 hours or more. So, we can't pay you for this, but because you're our friend, so we just have to say a very big thank you. So, thank you very much. Over to you. Is it Kunle now? Kunle, back to you.
Yeah, thanks, Yemi, and thanks everybody for your time to be here. It's an honor to be able to share the little that I work with every day with everybody here. I think I want to use the opportunity to also maybe do a bit of promotion for my fintech company, Paid-in. We're going to be on TV tomorrow, 10 a.m. on Silverbed. I'm going to send details to the faculty group so you can watch it and see your friend on TV talking about what we're doing at Paid-in. Thank you all and have a good evening.
Thank you very much. Good night, guys. Thank you, everyone.